Hello, everybody. Is everybody enjoying the big REITs, bonds, equities sell off all over the world? This is a complete massacre, bloodbath on the streets. I'm sure a lot of people are pissing their pants off right now, sleepless nights, thinking what's gonna happen. Are they gonna die? So on and so forth. Well, if you've done your analysis right, and I think you've done the proper things and diversified and make sure your balance sheet is strong, you shouldn't be worrying at all. I'm not worrying at all. I think my selection is good, and I'll just hold and collect the dividends over the long run. So it's time to analyze MIT's first half 23 numbers, and the title for this video is Ohayo or Sayonara. So I'll talk about why this Japanese-centered theme subsequently. But let's look at the MIT's share price performance for the past 1 month. Actually, I thought amongst the portfolio, this REIT has done actually pretty well compared to some other stuff. I don't own Capital DC at all, and you can see it's just collapsed 20%, which I thought was very expected actually. The yield is just way too low in the past. I'm not sure why people would buy KDC at less than 5% dividend yield in the past. It's just completely stupid. Capital Land Ascenders I've sold away at the 350, I think, earlier this year when I sold all my REITs in the STI. I warned that it's gonna happen, right? I said the STI is gonna collapse completely in the second half of this year, and I think the Fed is gonna stay higher for longer, and therefore REITs also fall dramatically. So therefore, if you are REIT in the STI, you're gonna get killed. So this stuff is down 30%, I think, since I sold 6 months ago. I'm not touching it though, because I have concerns about the US office properties in this REIT portfolio. I don't want to touch it. So far, I think this guy is done pretty okay. It's down from my purchase though. So I bought during the preferential offering, and now it's down. Actually, it held up above the offering price for quite a long time, but it just couldn't stand the ferocious selling for the past few days. The rest of the REITs in my portfolio has done really badly. Capital Land China has gotten killed. Capital Land India gotten killed, falling 6% yesterday actually. iREIT completely slaughtered. I think a lot of people are getting margin call and just incessant selling all over the place. Just ridiculous. Even Ames and Star Hill Global are also getting sold off. It's just a massacre all over the place. But I'm not losing any sleep though. I think the fundamentals are still strong, and I think this REIT is an example of what's gonna happen subsequently actually. But let's talk about the macros. Why is this happening? It's because of the rise in the longer term treasuries. Look at the 10-year treasury bills, right? Rising from below 4% in August to now 5%. So 1% jump in the 10-year treasuries. You expect everything to fall by at least 10%, 10 to 15% at least. It's a dramatic tightening of financial conditions, and it's a confluence of many factors actually. The first is, of course, a stronger US growth. You can see the third quarter US GDP is at 5%, and the consumers in the US are just not stopping. All the money printing and handing out of helicopter money has boosted the US consumers, and they're spending like no tomorrow. I don't think this is gonna happen. The US consumers are idiots. They just keep on spending, and then subsequently they will tap on credit, and subsequently they will just collapse in a complete collapse subsequently when the economy slows. And I think the economy is slowing. It's very clear if you look at the S&P and the if you strip out the Magnificent Seven, the index is actually very weak. A lot of the companies are just suffering, and I think the recession is coming fast and furious. Typically, monetary conditions transmit with a 12 to 18 month lag. I think given that the fact that raised rates above 3% end of last year, you're gonna see the recession coming in the next so 1.5 years from last December. So I think the December to the June 24 period, you're gonna see the economy slowing really fast. I think shit is gonna hit the fan very fast. So of course, the main thing I think is this: just a higher budget deficits because of the useless nature of the U.S. politicians, and the Congress will just keep spending and spending. It's completely stupid, in the U.S. where you have the central bank tightening monetary conditions, but yet the government coming out and spending like crazy. So monetary conditions are tightening, but yet the fiscal spending and stimulus is still continuing. It's a complete contradiction and a complete reflection of how dysfunctional the U.S. Is right now. It's just a complete disaster. Of course, when you antagonate your biggest buyer of your debt, which is China, they're not going to buy your debt, and therefore there's weaker foreign demand on top of a bigger supply in the US treasuries. So of course the 10-year treasuries will fall, which is why I've been saying for a long time, don't buy US bonds. for the past 1 year. People saying, oh, safety, safety, rubbish. It's complete rubbish. And finally, last mile inflation. Actually, I think the US inflation measures from official sources are way too wrong. It's just too laggy and it's completely off. If you look at the real-time indications of the US inflation, right now we are around 2.3 to 2.6%. So a far cry from the 3.5%, 3.7% that the US official numbers are showing. So we are already down to 2.5%. But the problem is that the last mile inflation down to 2%, it's gonna take a long time to materialize. Especially now that you have this Middle East conflict driving up the price of oil. Of course, US is again the big antagonizers in the Middle East. So this is all the US. The US is just a bloody pain in the ass. So I think all these factors are driving the long-term yields higher, and therefore you see a immediate repricing of risky assets all over the world. So let's talk about MIT's numbers. I think the DPU, of course, is the most important, and actually outperformed what I thought. I thought the DPU for this quarter will come in at 3.1 to 3.2 cents, but it's 3.32 cents. It's all capital top-ups though. Because last year there was a 3.36, but this 3.36 DPU comprises of 1.96 million of capital top-ups, right? That will end. So I thought this quarter, this stuff will end, and the DPU will just fall by $2 million. So translating to like 3.1 to 3.2 cents. But surprisingly, they came out with another bunch of capital top-ups out of nowhere. So it's a divestment done in 2020 or 2021, and now they're distributing the capital out. So that works out to be a total of 3.2 million. So that boosted up the DPU to 3.3 cents. So this is better than what I thought. So it's stable on a quarter-on-quarter basis, right? Year-to-year basis, right? So I think this is going to be the playbook for a lot of REITs actually, to do capital top-ups when the interest costs are rising. So not all REITs will have the luxury of doing so though. I think the REITs which have a good balance sheet, healthy and quality assets, should be able to do some quality transactions and divestments, and use the profits from the divestments to do capital top-ups to tide it through the next 2 or 3 years of high interest rates. Of course, there will be impacts of higher interest costs on the DPU as well. So the net overall effect should be negative. So whether or not your REIT can survive this crisis, you better look at the asset quality and decide. Not all REITs will make it through this crisis, I think. A lot of REITs will fold, and I think there'll be massive value destructions for the REITs with weaker balance sheets and horrible assets. The noteworthy point of this presentation is also the NAV. NAV has actually gone up from 1.85 to 1.88. So the cap rates have stayed pretty resilient actually for this portfolio. And the strong US dollar, when translated into Sing, means that the NAV actually went up. Quite rarity given what's happening, because you see cap rates all over the world, especially in Europe and Australia, are spending very fast. So NAVs are taking a big hit, leading to a natural rise in the gearing ratios as well. One final point which I thought was quite very interesting is the strategy for the REIT going forward. So let's look at the ALM management for this REIT. For the debt end, their total debt of 3.06 billion, and they've utilized out of this 3.06 billion, 12.6% is Japanese yen, right? So, and look at the asset side of the equation. 9.2 billion is in AUM, out of which the Japanese assets is around here, right? So if you look at the math, the absolute yen borrowings is 385 million, and the total valuation of the Japanese assets is $392 million. So just work out the math, right? So what they did was for the Osaka data center acquisition of $392 million, they actually borrowed the entire amount in Japanese yen. So they achieved the positive yield spread and locking in the yield spread, and at the same time, through natural hedging of the balance sheet, balance out the FX risk. I think what's going to happen subsequently is that you're going to see a very active repositioning of the REIT in terms of their assets. So they will sell a bunch of their assets which have a limited growth going forward. So I think they will sell their business parks. I think they will sell some of the flatted factories. I think this ramp up building should also go as well, because this is more of logistics, right? And logistics are now trading at a decent cap rate. So if they can recycle all this stuff, sell it at a pretty attractive cap rate, especially now that Singapore assets are still quite resilient. And then deploy everything into the Japanese data centers and deploy the same strategy of borrowing the entire amount in Japanese yen, locking the FX, locking the yield differential, and at the same time hedging away the FX risk in a natural fashion. I think this would be a very, very positive move for this REIT going forward as well. Especially by doing so, they move towards a more pure play data center REIT, and thus commanding a bigger premium over the price to book. So I think going forward, this will be what I'm looking for this REIT. So active portfolio rebalancing, recycling some of the capitals into Japan, and partially utilizing some of the proceeds to top up the DPUs to withstand the headwinds from rising interest rates going forward. So I don't think people are very interested in this video because nobody is interested in REITs anymore. Nobody is interested in investing anymore. Everybody is just selling everything in complete panic, which is of course a mistake.